This is how you pay $0 in taxes on your rental income. Hey, how's it going everybody? It's Justin Artist checking in again, and today I want to talk about taxes. So there's a lot to talk about today, so let's get right into it. But before we get into that, I am not a tax professional. This is just stuff that I learned over the years. So if you are seeking tax advice, please reach out to your CPA. So just like any other income that you earn, if you're making money from a rental property, Uncle Sam is going to want his share. So if you have a house that you're renting for $2,000 a month, that's $24,000 at the end of the year that you're going to have to pay taxes on. The good thing about real estate is that there's a lot of things that you can use to offset some of this income. Some of those simple things are your mortgage interest, your property taxes, your property insurance, your phone bill, your property management fees, any kind of advertising costs or business miles that you might occur, or travel expenses that you might occur if you have property that's out of state and you're flying to go check in on the property. But here's where it gets interesting. So like we said in our previous video, you would normally expect that your house would appreciate over time, but for tax purposes, you actually get to claim your house as a depreciating asset to offset some of that rental income. The IRS is letting you treat your property just like it's a car, for example, and assumes that it loses value every year, but really we know that it actually goes up every year. Continuing with our above example of the $24,000 that you made last year, let's say that all the deductions that we previously mentioned get you about $16,000 in deductions. So that leaves you with $8,000 that you would end up having to pay taxes on for that year. But now, if we consider depreciation, the IRS says you can take the value of your home, divide that by 27.5, and then whatever that number comes out to be, you can claim that much in deductions for that year. One caveat to that is you cannot depreciate land, so you have to take the value of your home minus the assessed land value, and whatever that number is, you divide by 27.5. They picked 27.5 just based on the depreciation schedule. That's just what the number is, so you just have to take that with a grain of salt. So let's assume that you bought a house that is $300,000. The land value was $30,000, so that leaves you with a $270,000 building value. Divide that by 27.5, and then that's roughly $10,000 a year that you can use to offset some of that rental income. So in this case, with the $8,000 that you have to pay taxes on, that $10,000 will completely offset it. And don't worry, that extra $2,000 you can save for the next year to be able to offset more rental income. So in that previous example, the deductions for depreciation was enough to fully offset the remaining value that was left over after all the standard deductions. But in some cases, there might not be enough just based on the linear depreciation to offset all the income. So what you can do in that example is a cost segregation study. So what that is a company will come in and they'll look at the value of your home and all of the things in it. So they'll take that $270,000 and they'll take a deeper look. So they'll look at things like the carpet and the countertops and the framing and the electrical and the windows and the appliances and the HVACs and everything else in your home. And then they'll assign those different depreciation schedules on a 5, 7, 15, and 27.5 year basis. And then you can depreciate all those assets on the specific depreciation schedule that they fall into. So what that does is that allows you a lot more money on the front side of the depreciation schedule to be able to offset the income sooner. So all of the things that were on these shorter depreciation schedules, so the 5, 7, and 15 years, the total value of all that can actually be depreciated on year 1. So that's called bonus depreciation. So depending on the year, the IRS says you can claim a certain amount of that on year 1. Currently it's 100%, so you can use all of it year 1. So typically, if you do a bonus depreciation, you should expect that 30% of the value of the home will be able to be written off year 1 in terms of depreciation. So in this case, we had a $270,000 home, so that's $91,000 of depreciation that you can use to offset any rental income. And this can be used for other rental incomes as well. So what a lot of people do that have large portfolios of rental incomes, say they have 100 doors and they make a couple $1 million in rental income, they can claim all the standard deductions for all the rental income from all the different properties. But then at the end of the year, they see how much is left over. So then they do a cost segregation on 5 to 10 homes to get all that bonus depreciation to then write off all of the excess income above the standard deductions. So they get away with paying no taxes on none of that rental income for all 100 of those homes. And again, any depreciation that isn't used this year can be rolled over to depreciate income from the following year. So you can see how powerful bonus depreciation can be, because it allows you to pay no taxes on none of your income. But then what's the catch? So the catch is, if you sell the property, you have to pay back all of the taxes that you would have paid had you not claimed depreciation. Just a quick tip, some people don't claim depreciation because they know about depreciation recapture, but the IRS assumes that you depreciate the property regardless. So whether you do or not, if you sell the property, you're gonna have to pay back depreciation recapture. So with that in mind, you might as well just go ahead and claim the deduction so you don't have to pay the taxes twice. So there is a way of getting out of depreciation recapture if you want to sell your home, and that's by executing a 1031 exchange. So a 1031 exchange is just simply buying another piece of real estate within certain stipulations outlined by the IRS. So a couple of those being, you have to identify the next property you want to buy in 45 days, and then you have to actually close on that property in 6 months, and you have to buy like-kind property. So what essentially is happening, the IRS is saying, hey, you can not have to pay taxes on that money if you just reinvest into more real estate. So this doesn't really make the taxes go away, but it just pushes them down the road, and you can keep buying and selling properties in this way and kicking that can down the road until you eventually do sell without doing a 1031 exchange. But like always, there's a way to get out of that as well, which we'll talk about at the end of this video. Another big tax burden that you can incur while investing in real estate is capital gains. So like in our previous video, when you're using forced appreciation to increase the value of your home, if you then sell that home, you have to pay capital gains on the net profit at your normal tax rate. If you hold that property for 1 year, you can then sell that home and only have to pay at the 15% rate, and that's the long-term capital gains tax rate. So there are a couple ways to get out of paying capital gains. One being to live in a property for 2 of the previous 5 years. Another one being to do a cash out refinance. So if you refinance out your money, you can take all the equity out without having to pay taxes on it. And then third is to do a 1031 exchange again. So you can see how powerful some of these tax benefits can be when used properly. In my opinion, there's no other investing strategy that can compare. So here's how smart investors invest in real estate. They buy undervalued properties, and then they fix them up to take advantage of that forced appreciation and gain all that equity. And then they rent them out for top dollar, and they don't pay any taxes on a rental income with all the tax benefits that we talked about in this video, including the bonus depreciation. And then they 1031 exchange to get out of depreciation recapture and capital gains to buy even more undervalued property, and then repeat that cycle time and time again. If done right, this maximizes the 4 different ways that you can make money in real estate and hyperbolically increases your net worth. All the meanwhile, you're racking up a huge tax bill every time you 1031 exchange, up to tens to hundreds of millions if you're doing this on a very large scale. But when you die through estate planning and you pass all of those properties on to your heirs, they get a step up in tax basis, which essentially makes all the taxes go away. Yes, you heard that right. You can invest in real estate for a long period of time and rack up $1 million worth of taxes. And then you can pass that on to your kids whenever you pass away, and then they get that step up in tax basis, and those taxes never have to be paid. And that, ladies and gentlemen, is generational wealth. And those that know how to use it, pass it on from one generation to the next. Hey, thanks for watching. If you made it this far into the video, please don't forget to like, subscribe, and comment. It really does help out the channel.